Welcome to my channel, and today we'll be talking issues relating to capital budgeting, and a key concentration will be on these three performance measures of a project. Accordingly, we have 6 or 5 methods in which you can apply capital budgeting problems. These are classified into discounted criteria and non-discounted criteria. So we have 2 components. So the discounted criteria includes net present value, benefit cost ratio, and the internal rate of return. By the non-discounting criteria methods, we include payback period and accounting rate of return. In the previous video, we have discussed this accounting rate of return. So if we want to see the content, please refer to my previous video, as it contains all the details which has been prescribed. Now in the 2 hour, we're going to concentrate on net present value, internal rate of return, and the profitability index. I will start with capital budgeting itself. In a nutshell, this is a process of identifying, analyzing, and selecting investment projects whose return cash flow are expected to extend beyond 1 year. So if you had a project which the duration is 8 months, so it's out of scope of this capital budgeting. And as I said, capital budgeting cash flow are classified into 3. The first one is initial cash flow. The cash flow that includes acquisition of machine, plants, equipment, installation of machines, testing of equipment, and others. These are the cash flow which arises at the beginning of project when it commences. Accordingly, when the project starts producing income, then you have interim cash flow, where an accountant is required to prepare the statement of performance, the income statement itself, so that there is income you are selling, and then there is operating cost, and the plant are now depreciating. So in this ground, we have to see what is a component of interim cash flow. So we have a units produced, the selling price, variable cost, fixed operating expenses, depreciation, and you have to account for inflation of the cash flow to reflect the real terms. Lastly, at the end of project, assuming the project is 4 years, so you need to dispose the machine. You need to pay the tax. If taxes are in arrears, you need to recover the net working capital as such. So there is 2 cash flows. We have net salvage value, and we have recovery of working capital as 2x here. So I want to concentrate here, but I will see what is the component of this problem itself. As I said, you need to ascertain the initial cash flow. As I said, installation, testing cost, freight, insurance, stamp duties, initial working capital, etc. So these are the cash flow which arises in year note at the start of investment. Interim cash flows are the cash flows which arises between the duration of the project and the final year project. The final year cash flows are the cash flow which arises at the end. So this is capital budgeting. Now a problem is, if a company has several projects, say A, B, C has several projects in different regions, say you have project 1, project 2, project 3, and project 4. So our question is, do we have enough funds to run these 4 projects? Now, this is a problem of economics. Number 2, you have to assess whether these projects are profit making. Are they viable to execute? So, once they are viable, then you rank them based on different criteria. Remember, we have strategic projects as to X, but then we have to think whether those strategic projects are worth taking. Now, in order to decide, as I said, there are several methods, including the net present value method, the ARA method, and then profit index method. We have ARA method. We have the payback period methods. So today we're going to see how the net present value can be applied in deciding which project to implement and which project to reject. Before going that, let us see what are the basic characteristics of cash flow in capital budgeting as per our decision making. The first one, the item must be cash. So you have to exclude depreciation, amortization, and impairment. Number 2, the cash flow must be incremental, meaning those cash must be arising because of implementing the project. Number 3, the cash flow must be reflecting the future. Therefore, all past cost or research cost must be expensed. You can't capitalize in the project because they are sunk. Number 4, in capital budgeting, we don't include dividend payments and finance cost. So if you have borrowings to finance a project, the interest costs are not included in the project. And I will explain this. Also, dividend payments are not included in the project. By the reason being, the cost of capital, which is used to discount this cash flow, contain equity and debt. Because actually, in capital budgeting, the term work, it is a weight fraction of equity times cost of equity plus weight fraction of debt times cost of debt. So this discounting factor, which we use them to discount the cash flow, is a component of cost of capital. Now the cost of capital includes equity, which is the cost of capital of equity is dividend. The cost of capital of equity is dividend payment. And the cost of capital of debt is finance cost. And that's why we should not include this finance cost when including the cash flow during decision making. Number 5, the cash flow must be called after tax cash flow. And this is enough for this kind of analysis. So let us see now. Here, project cash flow. Remember, do not include, say just a summary, depreciation and amortization, impairment. Again, you must be reflecting the future. And then there must be incidental. And then do not include finance cost and interest. That's the summary. Now, the procedure for getting net present value, you must extract this component here. Actually, the examiner can give you this net operating cash flow so that you discount them to get NPV. Or the examiner can provide you with this single item of cash classified A, B, and C, so that you reach at the final level of operating cash flow to be discounted. Now, let's me go to the essence of the problem. Say for today's discussion, we are talking about the net present value method as a method of applying project in capital budgeting. In actual sense, the net present value or net worth applies to a series of cash flow occurring at different times. The present value of a cash flow depends on the interval of the time between now and the cash flow. It also depends on discounting rate. NPV accounts for time value for money. So, the term NPV is a difference between cash inflow. The NPV is a difference between discounted cash inflow and discounted cash outflow. This difference here. So if this NPV is positive so far, if NPV is positive, this reflects that the discounted cash inflow exceed discounted cash outflow, and thus the project is profit making. So it is financially acceptable because its profit exceeds expenses. So we have to advise the management to implement the project under this method. If NPV is negative, what is our decision? We are saying discounted outflow exceed discounted inflow, meaning the expenses exceed income. Therefore, this is a loss making so far. Thus, a project is not profitable and a management is advised to reject it. Now, if the NPV is 0, this means that discounted inflow is equal to discounted outflow, and therefore the management is indifferent. It can use other factors to make a decision, or if it accepts, it's okay, and if it rejects, okay, because it is indifferent. So far now we have discussed what is NPV. NPV is a difference between discounted cash inflow and discounted cash inflow. Such difference will enable the project manager to either reject a project or accept the project. This is a simple definition of NPV. So at the read notes, that is very good. So in summary, we are saying, if you had a project proposal so far, so a proposal may be accepted or rejected. So the first case, you compute the present value of net cash flow. So this is discounted cash inflow. Again, you have capital investment. This is discounted cash outflow. So you make a decision now. If it is positive, accept. If it is negative, reject a proposal. So this is how it works. So NPV become a decision too, whether it is 0 or it is negative or it is positive. So you make a decision based on this computation. Now, what are the basic advantages of this method? Actually, the advantage of NPV, in fact, the NPV includes the fact that it considers time value for money. So that is very important. So it considers the time value for money, and it helps the management of the company in better decision making. The one key issue, it considers the time value for money. That is how it works. Number 2, NPV method also tells us whether an investment will create a value for the company or the investor, and by how much in terms of figure, either TZS or dollar or pound or euro. So it tells us how much it will create the money in monetary terms. Actually, the IRR, the accounting rate of return, does not provide this information. Number two, NPV method takes into consideration the cost of capital and risk of risk of a project in the future. While remember, the accounting rate of return does not take into account the risk of project about future. But this method, because as I said, this method uses cost of capital as a discounting rate. And therefore, it makes the source of finance, which is equity plus debt, to be included during the decision making. And also, it assesses the risk about future production of this project. In general, a projection of cash flow 10 years into the future inherently less certain than cash flow projection of next year. Cash flow that are projected further in the future have less impact on the net PV present value than more predictable cash flow that happen in earlier periods. Let's see. Number 4, we are saying the NPV is additive. If we have multiple projects and excess capital, you can add up projects to get a sense of aggregate wealth creation from all investable projects. Number 5, NPV uses cash flow rather than net earnings, which includes non-cash items such as depreciation. So this is another advantage of NPV. Again, NPV accepts conventional cash flow patterns. What are the conventional cash flow patterns? These are the cash flow which are in line as follows. For example, initial investment, $1,000. In year 1, you have a loss of $400. In year 2, there is a profit of $300. In year 3, there is a profit of $800. In year 4, there is a loss of $100. So NPV will take account all these patterns which are distorted patterns. They are not uniform, they are ununiform. This method will take account all this kind of movement of cash flow of a project over the given period. While the other methods such as IRR, it will take the average. Considering the average will not be able to assess the uniform pattern of this cash flow. Number 6, NPV is a good measure for profitability. If you wish to choose one single project from among many, NPV will be good measure of profitability if you use IRR for mutual exclusive project. Mutual exclusive project are the project which can't be executed together. You might end up selecting small project with higher IRR and short-term nature at the expense of long-term creation. Number 7, NPV has consideration of all cash flow. So NPV consider all the cash flow during the evaluation. While payback period will not consider this kind of cash flow because it only consider when is the investment back. So it just take advantage to make a cutoff when all the initial investment has been recovered by the profit after tax. So the discounting factor, NPV, almost takes all these cash flow within a project management. The risk factor, we're saying discount rate that attach NPV will take consideration of risk of business risk, financial risk, and operating risk. Therefore, this is a best method to be selected. Now, its disadvantages. Actually, what are the disadvantages of this method so far? The entire computation of NPV rests on the future cash flow and its present value using the required rate of return. As you can see, you can't get NPV without having the required rate of return. That would mean the figure for NPV depends on the required rate of return. Now, what happened? There is no guideline as to the determination of this rate. This method does not provide how do we determine the required rate of return. So, the rate is left to be discretion of companies, and there could be instances where NPV is inaccurate. Therefore, getting the rate, actually, it involves a lot of estimation, a lot of decision, which depends on accounting policy of a particular company. Therefore, every company has its own way of getting the required rate of return for discounting this project cash flow. Therefore, this would mean this computation of required rate of return involves inaccurate method, which is subject to a risk of error in the other cases. Number 2, the disadvantage of NPV includes the fact that it does not consider the hidden cost and can't be used by the company for comparing different projects of different size. So once the projects are in different size, this method cannot account for this problem. Number 3, NPV does not take into account any changes in the rate of return. So if the rate changes, actually, you have to start again computing a new rate. So the quality of recovering is considered stable for project, and any variation in the rate of return would require a fresh NPV. So once there is a variation of return, then you need a fresh NPV, because NPV is a factor of discounting rate. So once the rate fluctuates, you need to revise the NPV to have another decision making. So this one has been one of the shortcomings, as what it has been. You can go on reading this one. For example, estimation of total cost also is a problem. Difficult in defining the required rate of return, we have discussed it. We are saying optimistic projections. So those are further shortcomings. Let's now go to how do we compute the NPV with some vivid examples and determination so far. Question number 1. He said an initial investment is 20,000 Tanzania shillings now, and the cash inflow are 3-year cash flow of 500 each, plus 12,000 in 3rd year. Use 10% discount rate to compute NPV. So this one here is very important to note at every stage. What is happening here so far? Number 1, I will demonstrate this so that you understand clearly what does this mean. The following fact arises. First of all, the project is of a period of 3 years. So we have year 0, year 1, year 2, and year 3. Now, what is happening? He said, investment in year 0 is ZS 20 million. So this is ZS 20 million. Investment means this is cash outflow. Cash outflow. So in year 0, we have cash outflow. But the following now is taken serious. In year 1, there is an inflow of cash. of 5,000 Tanzanian shillings. Again, in year 2, there is an inflow of 5,000 Tanzanian shillings. Then in year 3, there is also an inflow of Tanzanian shillings 5,000. Now he is saying plus 12 in year 3. So in year 3, there is an additional cash flow 12. Now, this one is cash inflow. Now, NPV is defined as discounted cash inflow minus discounted cash outflow. This is a formula we need to understand. How do we handle this problem so far? We should now create a way forward on how to handle this one here. Years, and then cash flows, and then discounted factor, and then present value. So this is how you can arrange. So we have at year 0, and then year 1, and then year 2, and then year 3. So you need to assess some information here. What I can advise you is to make this table very short and understandable. Number 2, what is cash flow in year 0? It is 20,000 here. So minus 20,000 because it is cash outflow. So we have 5, and we have 5, and in year 3 there is 2 cash flow, which is 5,000 plus 12,000. So 5,000 plus 12 in year 3, it amounts to 17. Sorry, these are the cash inflow. Because cash inflow, positive, and we have positive 17. Now the discount rate at 10%. To get figure for discounting rate, you can use a calculator, and I'll show you how to go using a calculator somewhere. This is a calculator that you are having, so you can use this calculator to get these rates easily. Let us see first this demarcation as we go. So year 0, automatically year 0, the discounting factor is 1. So if you don't need to compute, so 1 times 20,000, get 20,000 at initial investment. So our computation rely on this 10%. How do you get those numbers so far? Using a calculator, you take 1 first, divide by 1, then place equal sign. 1 divided by 1, place equal sign. Again, divide by what? By 1.1. Why 1.1? because a 10% is a 0.1. So almost you divide by 1 plus a rate. 1 plus a rate, this is 1.1. So you place equal sign here. The first equal sign, you press first equal sign, it will give 0.9090. You press equal sign again, you get 0.8264. 8264. Once you press equal sign again, you will get 0.7513. 0.7513. Placing equal sign again, you get another number which will be given. So after having these numbers, so you put here, we have 0.909, we have 0.8264, 0.7513. Those discounting numbers, don't memorize them. It is very difficult even looking to the table. It may take time, but computing in calculator is easy. So from there, you multiply 0.991 multiplied by 5,000. So we get 4. It is 4,555.5. Again multiplying 0.8264 times 5,000. So you get 4,132. Again multiplying 17 multiplied by 0.7513. You get 12,772.1. Now the NPV, you say you must sum these two here. These three. Once you sum these three, you get total discounted inflow. So 45.5 plus 4,132 plus 12,772.1. This is 21. This total here I've got to be 21,449.6. Now NPV is discounted cash inflow, which is 21,449.6, and that's 20,000. So this is 1,449.6 positive. Therefore, having done this, the same method can be done. Of course, here we get positive this number, so just approximation. So from here, since NPV is positive, a management is advised to accept the project because it is financially profitable to the entity. That is the recommendation. So since it is positive, then advise a management to accept it. And I use different way of computing, but first of all, you have to get acquainted using this calculator here. It's very easy to use calculator and solve this problem. Okay, let's go to another problem. Now we have this project here. We have this project here, and this project, how does it work so far? He said project with a 3-year life and the cost of 100 generates a revenue of 25 shillings in year 1 and 45 shillings in year 2 and 65 shillings in year 3. The discounting rate is 8%. Now, what is the NPV? Again, it's easy because we have gone through this one. So let me make a summary here if you didn't understand me on the previous answer. But then I hope to go for NPV. Remember, discounting factor, this is the key issue to go, is equal to 1 over 1 plus R brackets power N. This is a formula for discounting factor. I beg pardon to you, should not memorize this formula because it won't add value to you. Discounting factor is 1 plus R in bracket power N. This is a formula. So R is equal to 8%. What I told you, you have to make the following. That step 1, you place into a calculator 1 divide by 1 equal, again divide by 1.08. So the first equal sign will give you the following number. Let us make it here. So 1 divided by 1 equal, 1 divided by 1 equal divided by 1.08. The first equal sign will give me 0.9259. The second equal sign will give me 0.8573. The second equal sign, when you place, it gives 0.7938. The third equal sign give you 0.7350. So this is a discounting factor in year 1. This is a discounting factor in year 2. This is a discounting factor in year 3. And this is a discounting factor in year 4. But fortunately, we have only 3 years. This is how we get this discounting factor using a calculator. And from here, I will now draw the line of demarcation on how to go for this project. I will now see this. I will arrange my cash flow in the way it appears in the problems. So this is year 0, and this is year 1, and this is year 2, and this is year 3. Okay. Now, in year 0, there is initial investment of 100,000. So it is 100,000. So I will put it somewhere 100,000 here. And this is the cash outflow. In year 1, the project generates 5,000 shillings. So it is a positive 25,000. In year 2, the project generates 45,000. So it is 45,000, but this is positive. In year 3, it is 65. So this is, you can classify here, this is initial cash flow, and this is interim cash flow. Fortunately now, we need to consider about the discounting factor. Discounting factor. In year naught, it is 1. But in year 1, it is this number, 0.9259. 0.9259. In year 2, it is 0.8573. 0.8573. In year 3, it is 0.7938. 0.7938. So we have done. Now, discounting factor will assist us having a present value. So you multiply the discounting factor times the cash flow itself. In year naught, we take 1 multiplied by this number, so that we have 100,000. This is present value. In year 2, there's 0.9259. You multiply by 25,000. You get positive 147.5. In year 2, you multiply 0.8573. You multiply by 45,000. So this is 38 positive 578.5 positive. In year 3, 0.7938 multiplied by 65, it is 51. 59.7. Now, these positive numbers, these are cash. We call them discounted cash inflow. That's good news. So this is discounted cash inflow. You have to sum them and get started. So 23 147.5 plus 38 57.8 plus 51 59.7. The sum is ZS 113,323. Now NPV, this is positive. So NPV is discounted cash inflow, which is 113,323 minus discounted cash outflow, which is 100. Therefore, NPV equals 13, yes, 1323, and this is positive. So NPV is positive to ZS 13,323. Having done this, now you make a decision. So, subject to errors, our fellow friends had this number. So you make a decision. This is a calculator, as I said, use it. Remember, you place this pattern here. So it is 1 divided by 1. 1 divided by 1. You place equal sign. Again, divide by 1. And then you place equal sign to have first number. You place equal sign to have second number, etc., etc. So that is the problem number 2. So recommendation are here again. You make recommendation as to whether you accept it or reject it. But since it is positive, then we are saying a project manager is advised to accept it because it is financially profitable. Number 3. You see, these problems are similar and you can solve them easily having the same way of solving it. Now let us see if there is a technical issue here. A project with a 4-year life and the cost of investment is 22500, generate revenue of 48 in year 1, 67 in year 2, and 95 in year 3, and 110 in year 4. If discounting rate is 15, then compute NPV and advise the management. So all the way it's very simple here, the same as above. So for practical reason, you can solve this problem and see if it corresponds. But this problem has been done for you, except you have to notice how do we get this discounting factor so far. Remember, you take 1 divided by 1 and then equal sign divided by 1.15. Why? Because this 15 is a discounting factor, this 15 here. So you divide 1 point a discounting factor. Now the first equal sign will give you this number here. It is 0.8696. Remember, these numbers are the same even if you use the discounting tables. The second equal sign will give you 0.7561, and the third equal sign will give you 0.6575, etc. So getting started, you discount them, you get negative, so you reject the project based on that. It is not financially acceptable because the cash outflow exceeds the cash inflow. Therefore, a project manager have to reject this project because it provides us with negative NPV. Let's see here. Initial investment in a project is 100 million, and then targeted rate or required rate is 12%. Cash flow are expected to be 60 million in year 1, 50 million in year 2, and 45 million in year 3. What is NPV? And advise a management. So also it's simple here, except you have to look on the way it works here. Actually, 100 million is initial investment, and this year 1 and year 2 and year 3 are the cash flow arising from this project in year 3. For 3 years. So in year 1, 2, and 3, discount rate is 12. Remember, using a calculator, you get these rates here, and then you multiply by the cash flow to get this positive value. So as you see here, this one is positive, therefore you accept the project. Once solving this NPV and the other cases, don't hesitate. Go straight forward to see the rate and you can make a decision. We have this question here. He's saying a company currently has a spare capacity and is considering taking subcontracting works periods for 5 years. A subcontracting work will clearly utilize the surplus machine. The net book value of the machine is this one here, 200 million, but the current disposal value is 100 million. The expected disposal value would be 25 million if the machine is used in 5 years. The depreciation of machine is set on basis over 5 years, and at the end of each year, net cash flow from the subcontracting is forecasted as follows. Determine NPV. Actually, this problem is a bit technical, but you have to think also technically. What are the initial investment so far? That is a problem. because we have incidental cash flow in year 1, in year 2, and in year 3, up to year 5. So this is in year 1, year 2, year 3, year 4, and year 5. So the way it works here, discounting rate is 10%. And therefore, you have to take care on how it works here. Let me give some overview here so that you can understand how it works. So wait first so that I can put a demarcation here for you to handle this problem. What he's saying, the company is currently having a spare capacity and is considering taking subcontracting works for the period of 5 years. The company has surplus machine and would otherwise sold it. This thinking is technical with engineering cases, but I will give you what is a vision so far, and you will be comfortable to see my observation. Now let's see. If, say, Mbeya Cement, for example, because he has not mentioned the company, yeah, assume Mbeya Cement factory, assume the company, as it says, it has a workshop. So this company has a workshop. Those who has been engineering, workshop will be equipped with machinery of different kind, and those machinery are equipped in a housing. For example, if you had department 1 and department 2. Now, why department 2? Actually, the machine must be highly equipped to tackle some problems. So what he's saying, he said that this machine in department 1, they are occupied with activity within the company. But machine in department 2 are idle. This is the way it works. Machine in department 2 are idle, while department 1 are fully occupied. So the company is thinking introducing a project here so that this project can use the idle portion of machine for 5 years. So this is an idea. So department machine are idle. Therefore, once they are idle, it is not generating cash flow. So the director is thinking to introduce a project so that this project would immediately use machine in department 2. Now what he's saying that the net book value of this machine currently is 200 million. The net book value reflects historical cost of the machine. Remember, in capital budgeting, we don't consider the historical cost because that historical cost does not reflect the future. Remember, relevant cost, the cash flow must be cash. Number 2 must be incidental, meaning arising because of undertaking the project. Number 3 must be future cash flow. Therefore, we can't consider the figure. So the 2 million figure must be rejected for consideration. Because he's saying the book value of machine, today we are making a decision here. We are making a decision here from a note. The book value, we have book value, it is TZS 200 million. This book value is ignored because it is talking about the past and not the future. Now, what's the future? The future is future and present. He's saying if we dispose somewhere, he said, but the current disposal is only 150 million. Therefore, the initial investment of this machine currently here, this machine has historical cost of 200 million, but the current book value is TZS 150. This value here. So this book value, this current disposal value is what we are going to consider as the initial investment. Therefore, Department 2 machine initial investment for this project will cost 150 million at a start if we implement this project. That is very important. We don't consider the 200 million because it is reflecting the past. And from the relevant costs of the project, we have three conditions: 1, 2, and 3. Therefore, 200 million does not qualify as a future cash flow. Therefore, identifying this one, you should place reliance on the following. So if the director of finance or the project manager is instituting this project, number 1, we have year note as initial investment, we have year 1, and then we have year 2, we have year 3, we have year 4, we have year 5. That is our key issues. Now, what is in year note? It is 150 million. 150 million as an investment. 150 million. Let me put this one here. And we are expecting to receive from the project 50 million, 65 million, 60, 70, and 5 in year 1, year 2, year 3, year 4, and 5. So you put 50. Inflow, it is 50 in year 1. Again, it is 65 in year 2. Positive 65. Again, it is positive 60 in year 3. Again, it is positive 70 in year 4. Positive 70. And lastly, it is positive 65. So 60, this is positive 70 and this is positive 65 in year 5. So this is the expected cash inflow if we invest in this project. Furthermore, we have been told that depreciation of machine is on a straight-line basis over 5 years, and the disposal value of this machine, the expected disposal value of this machine is 25 if machine is used for 5 years. So the disposal value is 65. So you must note here, very, very important, in year 5, the same machine will be sold for 25. So in year 5, there is additional 25 here. So in total, we have 65 plus 25. 65 plus 25, which is 90. Positive. Now, what is so far a good news? This is what has been reflected here. Yes, this ground here. So you should go now to the cash flow, that discounted factor. The rate is 10%. So it's easy to go for this one here. I remember you can now see 1 divided by 1 equal sign divide by 1.1, so that you get all those numbers easily. So the first number is 1 here. The second number is 0.901, 0.8264, and 0.7513. Again, we have a series of this number, 0.68. Let me compute again here to see the accuracy using a calculator, because I'm picking from my friend. So 1 divided by 1 equals divided by 1.1 equals 0.6830, then equal 0.6209. So you can multiply to get the numbers easily. What is in here? 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 So 0.9091 times 50. So it is 45.455 positive. So 0.8264 times 65. It is positive 53.716. Again, 0.7513 times 60. 45.078. Again, in year 4, it is 0.6830. Multiply by 70. It is 47 positive 0.81. Now 90 times 0.6209. It is 55 positive 0.881. So the discounted cash inflow can now get being computed easily by summing this cash inflow altogether. And once you sum them, we have 45.455 plus 43.716 plus 45.07578 plus 47.81 plus 55.881. So this is 2047.94 positive. So NPV can now be computed, that 247.94 minus the 150. So it is easy to have 97 as NPV. 97 positive 29. So accept the project. This is how it works here. So NPV would have been a solution to many of these problems. The same for question number 7 here. a company has a proposal to invest in a machine which costs 200,000 and it is expected to generate cash flow after tax for 5 years as follows. So we have year 1, year 2, year 3, year 4, and year 5. So we have 50, 75, 100, 50,000, and 75,000. Sorry, and 7,000. So cost of capital is 10. We said compute NPV. And also use, cost of capital is 10, use NPV techniques and PI method to advise and management. So we can go straight forward to see this information. This is easy. We have initial cash flow. Discount rate is 10%. These are discounting factor easily. So this cash flow has been computed. You multiply there by this one to get this one. So NPV is 60. So how to get 60 is discounted cash inflow minus discounted cash outflow, so that we can have this figure. So based on PV, we recommend to accept. But based on profitability uses this formula here. It is present value of all cash inflow divided by present value of all cash outflow. The figure for profitability index is 1.3, and since profitability index is greater than 1, then we accept the project. So you can use PI to make ranking, or you can use NPV to make a decision. So profitability index is also simple. You can compute also in other arrangement. And for this case, you can see further problem to be engaged. Now see here for question number 8. Again, the company is considering having 2 mutual exclusive projects. Now the word mutual project are those projects which can't be executed altogether. Therefore, a project manager has to select one among the 2. So the cash flow has been given, project A and project B. As you can see here, initial investment of project A is 500,000 and also the project B is 500,000. But the cash flow stream of 2 projects are different. Discounting factor is 12%. So a decision maker is advised to use NPV or PI, profitability index, to compute NPV of each project. For example, in project 1, discount factor is 12%. So you have to generate these discounting factors and multiply them with cash flows to have this figure here. From here, you can compute the NPV, which is positive 30,46,9. So that is positive. Therefore, based on this one, you accept it. Even using profitability index, you divide discounted cash inflow, this one here, divided by this one here. So you get 1.061. Therefore, we recommend that this project A should be accepted in all cases in our method. Now let's see the project B. This is our cash flow streams and they are discounted at the same rate here. So the NPV is also positive, 32.00. So the profitability index is also 1.64, but the NPV is also positive. Now, once you want to think, the NPV for project A is 30,000. NPV for project B is 32. Now, when ranking, project B is more profitable than project A, but both projects are accepted because of limited fund. Then you have to implement one of these projects. After having this short discussion with this NPV, It's now 1 hour. We have taken 1 hour. So my advice is to go and read between the line to see some techniques that arises in NPV so that you can come up with a good understanding. The next session tomorrow, I am going to describe the so-called internal rate of return and its computation herewith. Other cases may arise during discussion. Therefore, thank you for listening, and God bless you for your preparation of examination.